Mutual fund cash holdings just hit a 16-month low. 60% of fund houses bought the dip in March. Here's what institutional investors knew that the retailers didn't. In March 2026, the stock markets fell around 11%. FIs pulled out a record 1.2 lakh crores. Everyone was justifiably scared. And in that exact same month, India's top mutual fund managers deployed over 24,000 crore rupees to buy the dip. Now let's talk about what actually happened first by looking at the numbers. Total mutual fund cash holdings fell to 1.86 lakh crores in March 2026, down over 24,000 crores, that is close to 12% from their original level of 2.1 lakh crores in February. It's actually the lowest cash level since December 2024. Actual breakdown tells the real story. The biggest fund managers, SBI Mutual Fund, ICICI Prudential Fund, HDFC, and Motilal Oswal, all deployed cash to buy securities during this correction. These are in no way small bets. These are India's highest paid, largest professional money managers making coordinated high conviction bets at the bottom. First, the institutional insight that most retail investors never get access to. Mutual fund cash levels are one of the most underrated market signals in India. Understood simply, when fund managers build cash, they are basically saying markets are expensive right now, we won't buy. And when they start deploying cash, they say that this is the price that we were waiting for. Now let's talk about the institutional nuance that even fund managers look out for. Understand that cash deployment at market lows is a high conviction bet, but not a certainty. A scenario that could actually break this pattern is a prolonged war. If the Strait of Hormuz blockade stays beyond June 2026, crude oil could stay above $100. 3 or more quarters. That simply means imported inflation. Similarly, RBI would be faced to hike rates. Obviously changes the earnings outlook fundamentally. The FY27 earnings get revised down a second time. These March 2026 bottoms may not be the true bottom. Fund managers are well aware of this risk. And that is why those who deployed cash, they cut from the level of 5 to 6% to 4 to 5%. Meaning, even they haven't gone all in. They have simply averaged down. But in SIPs, then you automatically participated in this buying. Every amount that you invested in March bought more units compared to January. So you automatically participated the way institutional investors did. Exited in fear, however, then the data from every prior geopolitical shock says the same thing. We enter markets now, however uncomfortable. It is still better than waiting for confirmation at higher prices. We watch for two signals that confirm that this institutional call was right. Crude oil comes below $90, FI selling stops for 2 consecutive weeks. I hope you found this helpful.